Thank you for watching, and welcome to what is now the seventh episode of Financial Independence Retire Early South Africa. My name is Bird. Yeah, and on the seventh episode, I'll be talking about a few terms which I believe are very important for anybody who's trying to go on this journey of financial independence. These are words that can be taken for granted. I remember when I started this journey last year of trying to be, deep within the financial markets. I realized there's certain words I did not understand. I'd watch interviews from my favorite entrepreneurs. I'd read documents from my favorite companies, but I felt like I was not receiving the communication. I wasn't receiving the communication effectively because a lot of these contexts would fly over my head because I did not understand the words. So I figured it might be a good idea to bring together some of these words, bring them together for the next person who's trying to go on this journey of financial independence, or trying to be a retail investor, or trying to be an entrepreneur. These are words that will help you communicate effectively and be communicated with effectively. I hope that this task that I did of bring them together helps you as much as it helps me, because the more I teach, the more I learn, right? So yeah, these words, like I said, are generic words. These are words that you hear every day and people take for granted that you should know what they mean, but some of us don't. Some of us are self-taught. So like I said, I figured to be a good resource, and bring the words together, because I know this would have helped me, when I was starting on this journey, somebody to bring these words together and explain to me what they mean, so I don't make stupid mistakes. I don't sound like an idiot, trying to talk to other people, assuming that words mean one thing while they mean the other thing, right? But the first word I want to go through today is share. Very simple. We're all trying to be shareholders. We all want to own shares. But what exactly is a share, right? So a share is a small equal unit that shows company ownership. They are finite and can be aggregated together to a total of 100%. So, for example, I might own one share in BMW, right? That's one individual share. It's a unit of ownership. It's finite, right? It means there might be only 1 million of them available, right? So I own one out of 1 million shares, and that's the percentage of my ownership. 1 out of 1 million, not 1%, but 1 out of 1 million, right? So the other word for share could be stock. So a stock is a security that represents ownership of a fraction of a corporation. The units of stock are called shares. Again, the stock entitles the owner to a portion of the corporation's assets and profits, which are equal to how much stock you own. So again, BMW might have 1 million available shares. I own only 1 out of 1 million. That's a percentage of my ownership. So that 1 out of 1 million clearly is not enough for me to be a manager, or for me to, walk up to the company and say, hey, change ABC because I now own one share. That it doesn't work like that. You need a certain percentage of shares. If the shares are 1 million, maybe if you own 500,000 of them, right now you own 50% of the company. And now, you can maybe walk in and say, hey, ABC, I own half of your company. But 1 out of 1 million makes no difference. And also, there are different classes of stock or different classes of shares. The shares that you and I buy of the public market are common stock. There are other level of shares, which entitle people to maybe a board seat and things like that. But we own public or common stock, which we buy off the publicly exchanged market. And these are just small units of ownership, which only give us the right to maybe dividends or profits or portion of the assets of the company, if the company is sold, right? The other thing that we hear a lot, is stocks, shares, and bonds. Now, what are bonds, right? So bonds are instruments of debt. So a government or a company will issue out instruments of debts when it tries to raise money, right? So they can raise money from other people, from other governments, or from other institutions. So the company or the government will give out a bond, and this bond will say, hey, here is a bond for 1 million, and I'll be giving you 3% every month for the next 10 years, right? So now it means that the company that bought the bond will be receiving 3% of that 1 million every month for the next 10 years. And after the 10 years is done, then they get back their principal. So that's why bonds are then called fixed income, because they give you a specific amount of time that you'll be paid back in. They also give you a specific amount of return that you'll be paid in. So bonds are just instruments of debt. Companies and governments raise money by issuing out bonds. So you buy the bond, which means now the company or the government owes you because you bought that bond. The next thing we hear is dividends, right? What are dividends? Now, dividends is the distribution of some of the company's earnings to a class of shareholders as determined by the board of directors. So now, if I own one share in BMW, and BMW is giving out dividends this year, I'll be entitled to a dividend. And how much dividend I'll be receiving is determined by the dividend yield. Now, the dividend yield or the dividend price ratio of a share is the dividend received per share or the amount of money a company pays per share price. So it's a percentage, which is the amount of money a company pays of its profits per share price, right? So you calculate the dividend yield. The higher the dividend yield, the more money you get per share, and the lower the dividend yield, the less money you'll be getting per share. Now, the next thing we hear about a lot is holdings, right? Investment portfolios and holdings. So, what exactly is a holding? Now, a holding is content of an investment portfolio held by individuals or entities. These include stocks, bonds, and other instruments like ETFs and so forth. So, personally, I might own shares in 5 different companies. It means I have holdings in 5 different companies, right? Now, if individually I can have a holding, then what are holding companies, right? If a holding is my personal investment portfolio, then what is a holding company? So a holding company is also something that does exactly that. A company that works to just buy and sell shares in other companies. So a holding company is a company that holds outstanding um, shares in other companies. A holding company is a company that holds outstanding shares in other company. So if I were to have a holding company, it means that its function is just to buy and sell shares from other companies. That's a holding company. That's what it does. Now, that then brings us to the concept of private equity, right? So like I said, you and I'm assuming buy shares from the public markets, right? Which is the JSE or the New York Stock Exchange. These are public markets. Then you also have something which is the private markets, which gives access to private equity, which gives rise to private equity. Now, private equity is an investment class of capital that is not listed on the public exchange. Um, these these investors directly invest in the companies, right? And are usually hold private equity and are usually also members, board members, and management and things like that. So private equity is an investment class that does not exist on the publicly traded markets. So private equity buys and sells shares directly from the company or directly in between individuals and institutions, right? So and private equity also, usually have a class of shares that allow them voting rights or or board member seat rights and things like that. So, like I said, you and I have common shares. All we have right to is just dividends. But somebody that's in the private market and private equity can buy a class of shares that gives them rights to voting rights or to management rights or to a board seat and things like that, right? So that's what private equity is. Now, the other thing that exists in private equities is what people call mutual funds, right? Mutual funds. Now, mutual funds are open-ended, professionally managed investment funds that pools money together from multiple investors to buy securities that are retail or institutional. Now, what they provide, mutual funds, they provide economies of scale, they provide diversification, liquidity, and professional management. So a mutual fund, right, is an open-ended, professionally managed investment fund. So it means that you have a company and you pool money together, and then what the company does again is invest the money pooled from other investors. Then you have what is called a mutual fund. Now, the mutual fund just buys securities from retail or from other institutional. But the good thing about mutual funds, they say here, is that mutual fund provides economies of scale because it's money pooled together from multiple people. Then it's a lot of money, which means you have more impact. Diversification, because it's a lot of money, you can give the right amount of capital to different companies, right? So it allows for diversification because now you have enough money to diversify. Liquidity, again, it means you have a lot of money to take advantage of opportunities when they come, because it's a lot of money pulled together from different people. You can sit on some money and wait for the right opportunity, right? You're not necessarily timing the market, but maybe you're waiting for an IPO, so you're able to hold your money until the opportunity comes in for an IPO or something like that. So mutual funds provide that economies of scale, diversification, liquidity, and professional management, right? I've heard Warren Buffett say different things about mutual funds, but that's not the topic of discussion today. Um, for mutual funds, I'm going to talk about hedging. I hear this a lot: hedging, hedge funds, blah blah. What's a hedge? What's a hedge fund? Right? So I also had to research this, like when I started, because this term is used a lot, and people take it for granted. They think and I never knew what a hedge is. I thought it was a tree, bro. But anyway, hedging is risk management strategy meant to offset losses in investment by taking an opposite position in a related stock, right? So basically, you open buy and sell positions for short term and for long term. So it means, for example, if I believe that in the long term Tesla is probably going to rise, and I have a long position or I have a buy position, but I feel like in the next 3 months Tesla might go down, then I also have a short position, which is short term. It means I'm trying to make money from the share price going up, and I'm trying to make money from the share price going down, and that's what they say hedge funds do. So a hedge fund is a pool of money contributed by investors or run by fund managers whose goal is to eliminate risk and to maximize returns, right? So common goal is market direction neutrality. What that means is they try to make money despite the market fluctuating up or down. So market direction neutrality, that's what hedging and that's what hedge funds provide. They try to make money when the share price goes up, and they try to make money when the share price goes down. So it means that they hedge their risks, or they hedge their bets, as the phrases have been used. So it's exactly that, fund managers whose goal is to eliminate risk and maximize returns by having market direction neutrality. So they hedge their risk and they hedge their funds, and they make money when the share price goes up, or they make money when the share price goes down, which gives rise to another interesting concept, which we've been hearing about these recently since the Reddit, Wall Street Bets, GameStop, Nokia, AME, BlackBerry saga, right? Which is short selling. So it seems like hedge funds, probably participate in a lot of short selling, because short selling is that investing in such a way that will pay off if the share price goes down. So if I'm selling, or if I'm trying to take a position that will profit when the share price goes down, then it's called short selling. So that's probably what hedge funds do. Hedge funds, they long, which is they buy stock, and they also short it, which means they try to sell it or they try to make money when the share price goes down. Something that we keep hearing about is market cap or market capitalization, right? So market capitalization is market value of a publicly traded company's outstanding shares times the share price. So basically is share price times the number of outstanding shares that are available on the market. So again, going back to BMW, right? So if BMW has 1 million available shares, and every share price is like $3 or 3 rands, then it means the market cap of BMW is that 3 times 1 million. Share price times the number of available shares. That's your market cap. Market cap just indicates how much people are willing to pay for the company, right? Market cap does not necessarily mean that's the entire combined value of assets that the company has. So just because the market cap is 3 million does not mean that, if you buy their assets, if you get their cash, it will all aggregate to 3 million. There are companies who have 3 million rands in cash, but their market value is 3 million just because that's the share price. But they have 3 million in cash, which in theory they could buy themselves out, right? But again, market cap is just it's very relative to the share price, and the share price fluctuates. And the share price is just what people are willing to pay for that company at the time. It's not necessarily a direct valuation of how much assets, debts, and everything the company has. It is relative to it, right? But it does not mean that because the company market value is 3 million, that all of their shares and assets, all of their assets and liabilities combined make up 3 million. They could make more or they could make less, right? And then we have something called a stock split. You might hear this word mentioned a few times. It's a stock split. So a stock split is when you divide existing shares. You divide existing shares in order to lower the trade price or to increase market cap. So we have 1 million available shares at $3. Tomorrow, we're gonna divide every one share by 3, meaning now every person that owns one share will now have 3 shares. And instead of $3 per share, it's $1 per share. So the value hasn't necessarily changed, right? I used to have 1 share at $3. Now I have 3 shares at $1. So how it helps the company is the company now has more shares available for buying and selling. So then they can raise money that way, or they can increase liquidity, the liquidity of the shares in the markets that way. So stock splits help a company when they're trying to raise money or when they're just trying to increase share liquidity. But as an owner, obviously, if the share price goes up, then the value changes. If the share price goes down, then the value changes. But at the moment of the stock split, as the stock split is happening, share price and value is maintained, in that sense that if I had 1 share at $3, now I have 3 shares at $1. I should probably start speaking in rands. I don't know why I refer to dollars so much, because I'm in South Africa. But as we speak about market cap, then we get to things like penny stock and and blue chip, right? So penny stock is a common share of public companies that is less than $5, right? It means that a share that's available on the public market for less than $5, or these are, yeah, okay, the definition said $5. That's not me. But common shares of small public companies which are less than $5, right? And then blue chip are larger companies with a larger market cap. They're reputable. They have long existence within their market, and yeah. So blue chip is that. Usually large market cap, share price is typically high. The company is a lot older, reputable, and has been existing for a while in their industry. Right. While a penny stock might be new, might not be new, but basically a penny stock is typically cheap share price, right? Cheap meaning less than $5, but also low market cap, might be new, and might be in the room for exponential growth, and that's why people would buy companies which are penny stock, because they're hoping that the share price will grow exponentially as the market cap and as the company increases in market share. Now, market share, that's a new word, right? What's market share? Now, market share is that, if every day 100 bottles of soft drinks are bought, and, brand A sells 10 every day, it means that their market share is 10%, because out of every 100 they sell 10, which means they have 10%, So that's what market share is. It's out of every time a person buys a product that you're selling, percentage wise, how often is your product bought, and that's your market share. So if your product is bought 3 out of 10 times, 30% is your market share. If your product is bought half a time out of 10 times, and that's your market share, right? So market share is just equivalent of a percentage of your company's access to the market of the products or the service that it's selling, right? And that's the last term, right? I went about 20 terms. I might have been flowing a little fast, but I think share, stock, dividend yield, holding companies, private equity, bonds, mutual funds, market cap, stock split, hedging, hedge fund, short selling, blue chip, penny stock. These are words that you're going to hear a lot. And these are easy words. These are words that have simple context. You just need to use them a little bit more. And every time you run into the word, apply the context, understand how it's being used, and it will improve and increase your vocabulary, improve your communication with other people, and also help you receive communication a lot better. I hope these words helped. Check my description for my communities, WhatsApp, Facebook, Instagram, all of that. Hit me up, tell me how to improve, right? Which words I, should have spoke about, which, and how also, what I'm trying to say is which tricks or which hacks, life hacks, mental hacks, do you apply in your journey to financial independence that you think maybe I can learn from and I can talk about, what are you doing on your journey in order to save or invest more? How can that help me, and how can that help anybody else that's watching? I'm interested. This channel is about just learning and teaching, but mostly learning. So hit me up. Let's share ideas. Let's share information, and let's enjoy ourselves on this journey to financial independence, with the hope of retiring early and retiring happy, right? Retiring happy. My name is Bird again. Hit the like, the subscribe, to go a long way. And I will be seeing you in the next episode.